The Kenya Pension Fund Investment Consortium. A bit of what KEPFIC is. It is a consortium mobilizing institutional capital for impactful infrastructure and geared towards creating a space of alternative asset investments. They are one of the great partners for the USAID Kenya Investment Mechanism, and today we are honored to have Mr. Ngatia Kirunge. And a bit of who Ngatia is. Ngatia is the current head of Secretariat of KEPFIC. He has been on the task force of re-engineering and transforming the urban development in Kenya. He was appointed by the Cabinet Secretary for Transport, Infrastructure, Housing, Urban Development and Public Works to impact the task force on re-engineering and transforming the urban development in Kenya. He holds a Master of Business Administration in Finance and Investment Management from Vanderbilt University, Owen Graduate School of Management. Those last 5 words, Ngatia, it is an honor and a pleasure to invite you to stage. Let's encourage him as he gets up.
Good afternoon, ladies and gentlemen. Thank you very much for that lovely introduction. Before I start my presentation, I want to first thank our hosts today, USAID's Kenya Investment Mechanism. As you heard, they have been a great partner to KEPFIC, and we are very honored to be here to talk about institutional investors, pension funds primarily, and how we are looking at infrastructure and other opportunities in the country. And when I say the country, I really do mean it's not just Nairobi, but around the counties, in places that you would not expect institutional investors to put their money in. So, ladies and gentlemen, as you have heard, my name is Ngatia Kirunge. I am the head of the KEPFIC Secretariat. KEPFIC stands for the Kenya Pension Scheme Investment Consortium, which is a consortium of local pension schemes from both the public and the private sector, large and small, that have come together to jointly assess and invest in infrastructure and alternative investments in the region, or in Kenya specifically. So, we have heard about the concerns about lack of investment options. And I'll tell you, it's not just a retail problem. Even institutional investors out there, the pension schemes, we're looking for more than just buying, the handful of equities on the Nairobi Securities Exchange and buying government bonds. And so working together with these pension schemes to look at alternatives like infrastructure has been a very exciting journey for us. It's not been easy, but we've been able to have some measurable success with the support of our partners, including and especially Kim. So we'll start off, I've mentioned who we are. So we are a consortium of local pension schemes. We are looking to invest over 25 billion across the country in the near term. And this is all in the search for competitive returns and for diversification for our member funds. I mentioned diversification away from just the traditional investment opportunities. But to do that, we also look to build the technical and investment capacity of our members and their stakeholders. So we want them to be just as comfortable with how a power plant or how a road project works in terms of getting your investing and getting your returns as they are with the government bonds and the stocks that I had mentioned. Also, very importantly, we are their collective voice, the collective voice of a lot of these of our members in engaging with the regulators like the CMA, as well as with the RBA, Retirement Benefits Authority. So, KEPFIC and Kim have come a long way. It hasn't been that long, but it seems like we've done quite a bit in the last 3 years now. So the idea of KEPFIC was born in 2018 when 5 like-minded pension schemes came together, and they had a similar challenge. Yeah, they were looking for diversification. They felt that they weren't really getting the most of the local opportunities as they could. At the same time, we had a big influx of foreign investors looking at PPP opportunities. And the question was asked, if you have offshore investors from the US, from Asia, from Europe, investing in our local infrastructure, Why aren't the local pension schemes doing the same? And that was a very troubling realization. So that was 2018 when we were just 5 members. In 2019, the Kenya Investment Mechanism partnered with KEPFIC, and they provided the technical support that really boosted us to become to take us where we are today. And one of the first notable milestones was getting infrastructure included as a distinct asset class by our regulator, by the RBA, which would then now do 2 things. So first of all, it would make it very clear that pension schemes can actually invest into infrastructure. Before, there was a bit of uncertainty. And no one wants to fall afoul of a regulator. They were unsure, what would the RBA think if I go and invest into this power project? But secondly, it gave the pension schemes the ability to actually measure and to have a quantum that they can invest into these opportunities. So right now, the RBA allows pension schemes to invest up to 10% of their assets into alternatives or into infrastructure specifically, which, as you will see, will unlock considerable amount of funding for development in our country. So that was, I think, in 2020. That was in September 2020. And as soon as the RBA introduced infrastructure as this asset class, we immediately launched. In fact, we launched the next month. You can go back, please. We launched the very next month in this very hotel here. And since our launch, our membership has grown from those 5 members initially to, I think this is a bit dated, just over 26 members with over 500 billion shillings in assets in total. And we have now mobilized over 10 billion shillings into 3 investment opportunities, which I will take you through as part of our lessons learned. So, we launched in October 2020, 1 month after the RBA made it clear that we can invest as pension schemes into infrastructure. You can see from the slide there, that we had some high-level representation at the launch. Key speakers included the former U.S. ambassador to Kenya, Mr. Kyle Makata. We also had our current Principal Secretary, National Treasury, Dr. Julius Muya. And we had the former and the late CEO of the RBA, Mr. Nzomo Mtuku. Now, it was really important to show this support that we received, especially from government. As you can imagine, government is facing competing priorities right now and are very keen on increased private sector participation into the country's development. So that's why you can see front and center, we had, we have had big support from the government. Our partners, first and foremost, the Kenya Investment Mechanism, who have been with us from the start. Other partners include the World Bank Group, who provide us with technical support, as well as MEDA advisors, who have helped us form a collaboration and a partnership with US-based pension schemes that are also looking at Kenya for investment opportunities. And KEPFIC, in its short time, has been recognized as an initiative that is worthy to be replicated across Africa. And we were recognized as the pension fund. Thank you. We were recognized as the Pension Fund Infrastructure Initiative of the Year across the whole continent. This was back in 2019. And we are seeing the pension schemes in West Africa and Southern Africa looking to replicate exactly what we have done, because they have seen the success that we have been able to demonstrate in the last 2 years or so. I mentioned that we have a collaboration and a partnership with international pension schemes, primarily those from the US. And we recently hosted a second delegation of investors who came to Nairobi. This was in April this year. There were over 30 US pension schemes and their fund managers who represent or who manage over $1 trillion worth of assets. Now, these investors are looking to walk this journey with local pension schemes. Yeah, they want to see that we are also participating. They look at their home markets and they see that the opportunities are not as lucrative as they are here. Everyone wants to go on this journey with someone who is, or with a party that is more familiar with these risks, at least with the local risks. So let's talk about pension schemes and infrastructure. Let's set the context first. We know that there's a significant funding gap, not just in Kenya, but across Africa. So in Africa, it's estimated that we need anything between 70 to 100 billion dollars more than we are currently spending for infrastructure development. And in Kenya, that's about $4 billion. And in fact, when we make this presentation and government officials are present, typically they come over to me and they tell me, you're underestimating the gap. Yeah, in their opinion, it's closer to $5-6 billion rather than the 4 that we are showing. And whether it's 4 or it's 6 or it's 8 or whatever, what is clear is that there is actually a need for private sector participation, as I will show you on the next slide. So infrastructure right now is typically being funded by African governments, so that's about 37%. Is there a lag on the others? Next slide. Yeah. Then you have China, about 25%, and you have the donor community, about 20%. Now, national governments are they're still a leading, but definitely a weakening source of this development finance. And that's only because they're facing very serious competing challenges. I mean, think about COVID and the economic recovery that's required, the healthcare needs of the country, and the likes. And the donors follow suit as well. And then you have the situation with China when as they have slowed down their road and bridge initiative, they're also investing less. So private sector is there with about just under 12%. And there is significant room for growth of private sector investors, and in our case, the pension schemes, insurance companies, to step in and fill that gap. Next slide. So this is just a snapshot of our pension scheme industry today. You can see it has grown significantly over the last 20 years. And we're now standing at about 1.5 trillion shillings in assets in total. And I mentioned that up to 10% of that can go directly into infrastructure as per the new RBA guidelines or regulations, which means today, if we find bankable projects, 150 billion shillings can be deployed straight away. And I hope that excites the BASPs in this room, especially those who are not just focused on Nairobi. Yeah? And why infrastructure? So infrastructure, I can just sum this very briefly. Infrastructure provides, 3 key attributes that are really important to us as institutional investors. First, it has competitive returns. We would not be here if that wasn't the case. And infrastructure returns are often very much, they look like bond cash flows. They're very reliable. Unlike some other investments where maybe you would find that the returns are lumpy. So you put in your money today and maybe you get your money out in 3 years, 5 years, it's uncertain. But infrastructure also provides that diversification I was mentioning. So no longer are you just limited to Safaricom, KCB, equity, and government bonds. You can look at, a toll road here, power plant there, and diversification is especially important today. If you look at our equity market, just like many other frontier markets or emerging markets, we've been hit pretty hard with the outflow of foreign investment. And so, as much as Safaricom is a solid company, until recently it was down 30%. And that has nothing to do with the fundamentals of the company, but it's more the flow of funds. And so diversification is key. Even if you think you're holding the best asset, the crown jewel, diversification is still really important. And finally, these infrastructure investments are long-term in their very nature. Yeah, you can have a concession for 20 years, 30 years, 40 years, or even longer. But that's not a problem for us, because we as pension schemes also have long-term liabilities that we need to match those assets to. So today a pension scheme is managing or is investing money for someone who will retire in 20 years. Yeah, someone who has probably just started work. And so they need to be sure that in 20 years' time, they have made the investments today that will allow them to pay out their members for the remaining life after they retire. So that kind of long-term thinking and long-term investing is very, very necessary for institutional investors like ourselves. So, so what do we look for? This is a highly simplified slide, but I think it can capture the gist of when we look at a project, what stands out to us, and what we definitely need to have ticked. So the first thing is, who is behind the project? Who are the project sponsors? And what is their track record? Now, that's deliberately the first one, because it is the sponsor's ability to deliver what the investment that they are promising that is critical. You can have a great investment opportunity or a great project that is put in front of you or in front of us, but without the sponsor being actually capable of executing that investment, and remember, these are long-term investments. What it says in the returns that they show us, whether it's on the financial models or on the teasers or prospectus, we have serious doubts. It puts that into question. So coming to the table with a credible project sponsor is extremely important. Then we move on to the actual project. So where is it located? In what sector is it in? What's the high-level business case and the business model for that particular opportunity? Then we move into the investment description. So how much is needed? And for how long? And through what instruments? Would it be through a bond? Would it be through equity? But also, most important, what are the returns? So I think it's important to just clarify, or maybe not clarify, but just to make it clear that pension schemes are commercial investors. They are not concessionary investors. They have a fiduciary duty to invest your money in the most appropriate and high-yielding opportunities out there, at least based on a risk-reward. And so returns are fundamental. And this money that will be put into any project or any investment is already sitting in other investments right now. Right now, you think it's primarily government bonds you'd find, and those handful of equities that I mentioned. So if the project doesn't have the sufficient returns to justify moving that money from those government bonds, which are quite high yielding right now, into the opportunity, it just will not happen, regardless of the story you put behind it. So the story is important, the numbers are critical. So as much as I've said that, it's also really key for us to understand the risks of these investments and how those risks have been managed. We are a very conservative bunch of investors. Very, very, no one would have a problem if you invested in a government bond or invested in Safaricom and something happened there. Yeah, when Safaricom went down 30%, no one was really worried that they could be blamed for poor stock selection or poor investment. But if something goes wrong with a power plant, the question that will be asked is, why didn't you just stay in Safaricom? Yeah? Why did you go into something as exotic as power? What do you even know about power? Yeah? So understanding these risks and how those risks have been mitigated is really, really important. And last but not least, we look at the environmental and social impact of our investments. As long-term investors, our returns would be threatened in the long run with the deteriorating situation around climate change. So today the returns may look good, but what if in 10 years' time there is a flood or there is flooding in the area that we have invested in, and we are no longer able to achieve the returns that we had banked on for 20 years. So those kind of considerations are key. So climate resilience, job creation, and gender inclusion are critical factors that we look at in our investment opportunities. Next slide. So, since our launch, we have engaged with over 50 project sponsors, and these project sponsors include investment banks, investment funds, commercial banks, and advisors. You can see a few of them in this room today. We have reviewed over 45 transactions and shortlisted 7. Now you can see it took 45 deals to end up at 7. So the bar is quite high. Yeah, the bar to get funding from these institutional investors is it's not easy. And I'll come to this is one of the reasons why I'll discuss this shortly. The importance of having a credible transaction advisor or a BASP that can help make these your transactions or the transactions you're looking at bankable and well structured. So, of the 7 investments that we looked at, that we shortlisted, next slide. So we were able to essentially mobilize just shy of 11 billion shillings from 88 pension schemes. And these were, thank you. So maybe put that into context. So of course, when we first started out, there were a lot of doubts that pension schemes would be willing to take this kind of risk. And not a lot of effort had been put into trying to get them there. And we had also seen how private equity had come to the market and had tried to raise money from these same pension schemes. And over a 5, 6, 7 year period, I think in aggregate, the private equity industry was able to raise not even 3 billion shillings, $30 million or so, from these pension schemes. But in 18 months, we have been able to do 3 times that. Yeah, three times that in only 3 opportunities. And that is a testament to a number of things. First, this 10 billion tells you that we are much more than a proof of concept. This shows there is a real investment appetite. And the opportunities are cross-cutting. They're in student housing, they're in mortgage refinancing, in roads, and we currently are looking at some in power. We're looking at in a whole host of other sectors. But I would like to take you through primarily the last opportunity, which is the road project, because that's the one that I think is really novel. Yeah, at least novel in the sense of us as investors participating. So that project is a road project under the Kenya Roads Annuity Program, which was introduced in Kenya, and it was based off its success in India. And the whole intention of this road annuity program is to identify 10,000 kilometers of roads to be financed through the PPP framework, and specifically through a finance, design, build, maintain structure. So where a contractor or where a third party is contracted by and procured by the government, and that third party is a private sector player. They bring to the table the finance, they do the designs, they build the road, then they maintain it over a certain period of time. This is new. We haven't, it's the road annuity program has been in place for about 20 years, but it's only now that we're starting to see uptake from that. And a lot of that is because there was always a need for local capital, which we are happy to say that we are bringing to the table. So the program is backed by the Road Annuity Fund, which is essentially, it's a ring-fenced pot of money that is the source of that pot of money is the fuel levy, where every time you go and fuel your car, 3 shillings of that goes to this road annuity fund. And that's what now pays back the investors that invest their money today over a 10, 15, 20-year period are paid back from this fund. And this is important because it's not the government essentially paying you from their budgetary allocation, which we all know can be a bit dicey. Yeah, it's never guaranteed, or at least it isn't as what's the word? It's not the investor community may have a few doubts about whether those budgetary allocations will be in place in 20 years' time. If you have a 5-year investment or 5-year payment plan from the government, that's one thing. But if you're looking at 20 years, those are 4 administrations. Yeah, and everyone knows that political risk is a big factor in the investment process. Well, we're lucky we have looked at this road annuity fund has been in existence for 20 years, and so we were very comfortable with the structure. And so that allowed us now to start looking at the actual project itself. And the project was 143 kilometers of road, yeah, two sections of roads in northern Kenya, in Wajir and Mandera counties, both of which I think you can agree have been deemed as previously marginalized, both of which you would not expect institutional investors to participate in. I think they have, as you can see there, both of them have under 0.5% of paved roads. But through a well-structured, bankable structure, you can see that private investors were actually able to invest in northern Kenya, right there on the border of Ethiopia. Next slide. So the total project value is about 18 billion shillings, with the government of Kenya putting in about 30% of that, that's 6 billion. And then you had the project sponsor putting in their equity of about 2 billion. And you had the banks at the very top with the senior debt, 8 billion. But the transaction still needed a chunk of capital from the local investment community for the subordinated debt. Without that 2 billion that they were looking for from institutional investors locally, the whole structure doesn't work. So this is another thing to highlight. Typically you would expect that a pension scheme is very, very conservative, so they would never look at subordinated debt, which by its very nature means it would be subordinated to the senior debt. So in case of anything, first the senior debt holders are paid, and then the pension schemes thereafter. But we are showing that not only was this project in a marginalized area, but we're also taking probably higher risk than you'd automatically think a local pension scheme would take. But from that, we have, I would say, our biggest success story from all those challenges. So what, you can go back, please. So what the sponsor did, what really helped this transaction is that, number one, they had a very credible transaction advisor in the form of Stanbic Bank Kenya. They structured this investment in the form of a bond, yeah, and I'm really glad to be speaking after the CMA because one of the lessons learned is the importance of using capital markets instruments. We also managed to get a guarantee in place from DFI called Garantco, which is backed by the governments of various European nations, including the UK, Switzerland, Sweden, as well as other nations like Canada and Australia. And at 12.6%, we had significant interest, and in fact, if you go to the next slide, we managed to raise over 2.5 times what they were looking for. So they were looking for 2 billion, we raised 5.1 billion. So very difficult transaction, very risky area. in terms of, not risky in terms of I'm not talking about the places risky, but marginalized, and so we're not very comfortable there. But you're still able to raise, multiples of what they are looking for. Yeah, 5 billion. And if you look at in fact, for me, the number is not as important as the number of pension schemes that participated. Because you can always maybe find 1 or 2 pension schemes that may be interested in taking this risk. But when you see 88 pension schemes, that tells you that there's broad acceptance and broad appetite. And like I said, from not just the big players, but also from those who are much smaller, those who are in the private sector, those who are in the public sector. So very broad adoption and appetite for these kind of opportunities. So, lessons learned. And I was thinking before I got here, when I was sitting down here, there are a few key lessons I should have put here. So the first one, as I have implied, is number one, there is a lot of appetite for bankable, well-structured opportunities. And that's where, like I mentioned, the transaction advisors and having a credible transaction advisor or a BASP is critical, because they are the ones who will help with the structuring of these opportunities, and they will also help give the investor community a lot of confidence. Number two, which is not here, is liquidity. We heard from Mr. Wayaki about the importance of liquidity, and it cannot be overstated. So yes, these are long-term investments. I mean, you can look at 20 years. But there will be a need for these schemes to liquidate some of these investments to meet their ongoing obligations. And so using capital market instruments like bonds or anything that really can be listed then allows a pension scheme to buy these opportunities today. And maybe in 5 years, 2 years, 10 years, whenever, they're able to sell that exposure to other investors who are looking for that kind of opportunities. The third one is that these transactions take time. And so, patience is key. That road project, it's taken me 30 seconds to go through it, but it took us 12 months or longer just to get to where we did. It takes some time. It takes some time, to go through, to produce all the documentation. There's a lot of back and forth with the various players and the likes. The next lesson that we learned, or that's important, is as much as we appreciate and look for guarantees, we also understand that they may not always be available. We were lucky in our case that we got a guarantee from, like I mentioned, Garantco. But what we see these guarantees more like training wheels. So we're new to this. So, just like a child when they're learning to ride a bicycle for the first time, they have their training wheels at the back, and eventually, they get more confident, and then you remove the training wheels and the child is up and down riding with a lot of confidence. That's the same with us. So we know that these guarantees may not always be available, but where they are, should certainly not come at the expense of returns. And finally, we've talked about the primary investment risks, but we haven't really talked about the non-investment risks, and that was very important. It was a lesson to all of us who are financially minded. We may focus a lot on the numbers. And on that list I showed you, but there are non-investment risks that we certainly had to consider, and it's important that everyone keep in mind. Things like reputational risk, political exposure, the role of government, all of those elements would have to be adequately addressed. So with that, I'm happy to take any questions. And once again, I want to thank our hosts, the Kenya Investment Mechanism, for joining us on this journey, for being such great partners, for allowing us to, giving us the platform that they have given us, giving us the operational support that allows us to look at those 50 transactions and really help build the technical and build the activities around our investment ecosystem and the pension funds especially. Thank you very much.
Then we can close it. Thank you.
Now, it's a question we get a lot, and I think it's important to state, number one, that we are not a fund manager. We are an association or a consortium of local pension schemes that are, have a common purpose. Yeah, we're looking for opportunities in alternatives. But the investment decision is still made by, by the fund managers and the pension fund trustees. And that's per the regulations. So we work very closely with the fund managers. The investment opportunities that we pre-screen are then presented to these fund managers and to their clients who are the pension schemes, and we help them in assessing those opportunities. But at the end of the day, the investment recommendation and really the fiduciary responsibility stays with the fund manager as per regulation. So we are their partner rather than a competing or fellow fund manager.
Right. Thank you very much, Ngatia, for that presentation and for being able... Mic one. Guys, could you help me to that segment? To that section, sorry.
Okay, I'm going to be very brief. Ngatia, thank you for that wonderful presentation that you have made. As I spoke yesterday, I'm a founder member of KEPFIC. As trustees, when we came together and decided that we needed to do something about investment into infrastructure, I must say that without the professional assistance of the USAID KIM team, we would really have been struggling. So I just want to appreciate their role in helping KEPFIC to come up to the level where we are now and for the growth that we have continued to see going forward. But one of the questions I'd like to perhaps ask Ngatia, even though I'm part of KEPFIC as well, is what are the strategies that we are putting in place to ensure sustainability and growth going forward? Thank you so much, Ngatia.
Just clarified, when you say sustainability, you mean sustainability of KEPFIC? Okay, great. So right now, KEPFIC makes its, KEPFIC is provided with a lot of financial support from our partners like USAID. But we know that that's not, that's not permanent. So like any other institution, any other association, our primary source of funding right now and primary source of sustainability is membership subscriptions. So I mentioned we have 26 members right now, and they each pay an annual subscription of anything between 150,000 to about 50,000, depending on the size of the scheme. So we're on the journey from being heavily donor supported and now becoming more self-sustainable as the market starts to see the value that we are bringing on both sides. On the side of the investor community, so from the pension schemes, as more pension schemes join KEPFIC, essentially we have more membership, but also on the investors. Yeah, tell me, to the BASPs in this room, you would certainly charge someone to raise, if you raise 10 billion for them, wouldn't you? Yeah, so there are opportunities for KEPFIC, as we continue this journey to become a lot more commercially minded while still maintaining our core vision and our core mission, which is to grow the capacity of an investment capacity and technical capacity of the local pension schemes and their stakeholders, all towards greater investments into alternatives.